Okay, is the housing narrative changing as we speak? I truly believe it is. Let's figure it out. Welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Today is the 8th of December. Randy Patrick here, putting the realism back in real estate for you. Lots to talk about here. I just saw some stuff that came through my desk, and I thought, you know what? I need to review this and kind of see what's going on here. But it's positive, though. It's positive, and I'll get to it in a second here. But first of all, if you're not a subscriber to my channel, I would love it if you would smash that subscribe button, help my channel grow, and I'd be very appreciative. So thank you very much, and to thank those who are already subscribers and for all the views that I'm getting on every time I release a video. So I do appreciate that. So here's the scoop here. I've noticed that the housing narrative has kind of changed, all right? And, has it changed? You betcha, it certainly has. And I'm going to go over that right now. So just again, I read a lot of stuff, check a lot of things out. I notice things that are happening. So let's put things into perspective, though, is that, I think everyone understands that we've got forbearance issues and default issues and delinquencies. So it's kind of like there's no running away from those at this point in time. I think that's kind of what I'm looking at, is that before it was a denial that there were issues. And then, as time goes on, you have to accept that, that there will be some issues going forward. And, the minute there's like a glimmer of hope for people like ourselves who would like to buy cheaper property, then they're trying to squash that glimmer and, trying to change the narrative so it's not going to work in our favor. And that's what I see happening right now. But first of all, I think it's interesting because we know that there's been a lot of people leaving locations, leaving the Northeast, leaving the West Coast, coming inland, coming south. And what I saw, this Fortune article here from Fortune magazine, if you flee the city, keep your salary, not so fast, say more employers. So what employers are doing now is if you're cashing out of your Northwest U.S. home or California home or New York home and you're coming down someplace cheaper, if they don't have to pay you what they're paying you before. That's kind of the information. It says it sounds like the perfect arbitrage opportunity. Leave your crowded city for a bigger place in the burbs, but keep your big city salary. Or not only that, go across the country so it's rural or semi-rural, etc. So people are changing locations and moving locations for quality of life, cheaper property, the whole bit. Well, what we're showing now is the fact that there's been some, I guess you could say an analyst going on and some sort of analysis going on and some surveys going on. And basically what we're looking at is there's a movement towards pay localization, which basically means, if we're allowing you to leave our location, our corporate location, for you to go have a better quality of life someplace else, then we're gonna we need to save money as well too. So I think that's interesting so a lot of people who are cashing out, it might work for them, or if they're moving, they may have they may not be able to afford the house or the land or as much as they thought they could or would, because their employer may be changing the basis of how the amount of money they're paid. So again, something interesting to not to look forward to, but just to be aware of as time goes on. Home buying sentiment may have peaked for now. Again, this has sort of been written about for the past couple of days. So what this boils down to is that the kind of the euphoria is over, and now it's settling in, and we've seen some. Obviously we've seen from that graph, the blue line, we see a little decrease in November's home buying sentiment, which it's the season, etc. I'm sure a lot of this has to do with unemployment, with more COVID restrictions and lockdowns and things like that, general economy as a whole. So there's going to come a point in time when real estate does sort of take a lull. This may be the start of it right now. Forbearance rate holds after 2 weeks of growth. So interesting thing about forbearance is that we're looking at this on a almost real-time level. So every week, Black Knight puts out what's called their mortgage McDash analysis, etc. And quite frankly, guys, what? I'm not even interested in this stuff anymore because it's the same old thing. I mean, I didn't do a video on the last Case-Shiller report that came out in November. Why? Because, same story. Prices rose again. There's less inventory. each location is doing double-digit growth. Like, it's not even interesting because we know what's happening. The narrative is being controlled, the market's being controlled, and this is the result of it. So it's if you're not aware of that, then you should become aware. If you disagree, disagree. But the point is, we're getting played here, and that's usually what happens when things are getting ready to change dramatically. So forbearance rate studies. Now, the thing I want to point out with the forbearance is the fact that while new forbearance requests declined for the week, exits slowed to a new low for the series. So what that basically means is the fact that, okay, we're not getting as many new people jumping and asking for forbearance. So I guess that's somewhat positive for the marketplace. Less people maybe are facing financial issues on a weekly basis. However, people that normally would be going through their forbearance program and exiting, that, hey, we've cured it, we're moving to a loan mod or something else, well, that's not happening, okay? So those numbers are decreasing. So that means that the people who are in the forbearance programs are staying in because they need to stay in. And chances are when forbearance ends, it's not like all these people are going to be able to, go out there and do loan mods or pay their mortgage and life is going to be good. That's not going to happen. I think this is sort of the realization that people are coming to right now with respect to what's going on. For example, here's an article. It's called "The Housing Debt Bubble is Going to Burst." And I look at these articles, I keep them for a rainy day, put them out now. Well, this group is, they're real estate investment advice.com is the it's early November is when it came out, is the website. And basically it says, here's how they look at this. These events are likely to unfold in the next 6 months. Virus growth uncontrolled, economic activity contracts, unemployment rises, personal income fails, consumers miss rent and mortgage payments, rent and mortgage payment moratoriums fail, consumers use credit cards to make payments, and that's what's happening. So people who don't have the money, they're not getting stimulus checks, they're now putting rent or these type of things on their credit card. And so again, they're just deferring more problems down the road. Small business, apartment landlords, and homeowners default on mortgages. That's when the debt bubble actually bursts, and consumer spending dives. So that's, they're saying their analysis starts by examining the third wave and a likely increase in lockdowns. So, and again, reading the news today, just going over stuff. There's more layoffs, more shutdowns, more stuff, being controlled. More, I saw something like 100,000 plus, restaurants are basically closed out of business now. So, this is really starting to sort of, really permeate the fabric of the economy here. So I don't think the things don't seem like they're doing well. Consumers miss rent and home payments. So when these guys are just, again, a talking point here, they're adding up what's not being paid. And basically what they're saying in the last paragraph says our forecast of $100 billion in looming housing debt builds on our earlier analysis in a recent executive post. That post identified two consumer segments, workers and professionals. We know that all homeowners reported no confidence in making next month's payment. Analysis indicates that 16% of professional homeowners reported little or no confidence in making a mortgage payment for September, yet workers reported twice the no confidence rate of professionals as rate professionals at 34%. So basically, this is starting to grow, okay? People have said, well, the renters are just the worker people. Well, it's starting, if that's the case, well, they've been having problems for so long and they're tapped out, and now professional wage earners are getting tapped out as well too. So this is not just one demographic of worker or employment. This is it's increasing to other demographics as well too here. Small business landlords default on mortgages. So really, again, we're talking about small business landlords, the ma and pa, the average Joe investor, which usually are 1 to 4 unit buildings. They're duplex, triplex, quads, single-family homes. Well, that segment owns about 22 million properties, okay? Well, only 12% of small unit buildings were covered by the CARES Act rent moratorium, which ended in July 31st. Some small business landlords have taken to evict tenants, but basically it boils down to cash flow crunching, right? And it says your survey of small business landlords found 40% of owners are not confident they can pay operating costs for the next few months. So this is what happens is you have a mortgage on one of your rental properties, you're stuck. Your landlord's not paying you. What do you can't move them or evict them, or for whatever reason it's taking time based on the state and location you're at. What are you going to do? Now you're suffering, and you know what? The problem is that these small business landlords, they're not covered by any special, you could say CARES Act, whatever you want to call it, or items. You know what I mean? Like they're not getting forbearance or relief. And if they do get forbearance, well, forbearance means they still have to pay in the end. And guess what? Do you think you're going to go back and get, 12 months or 9 months worth of rent from your tenant? Absolutely not. That's not going to happen. So it's stressing people out here, right? So basically, so I'm going down this part, homeowners default on mortgages. Okay, that again, we see that increasing. It's going to happen. All right, I'm going to move this a little quicker here now, guys. So so what I'm showing here is the fact that this is the narrative's changing. So there's an admission that we're going to have foreclosures. So we know there's going to be people coming into forbearance with defaults and issues. We know there's going to be landlords getting nailed down with respect to not being able to make ends meet. We know there's 1 million plus people out there who are delinquent. There aren't any forbearance program. Okay, previous videos I've talked about that there's estimates of maybe 1.5 to 2 million foreclosures conservatively, or homes being foreclosed upon in the next 2 to 3 years. So we know what's happening. So you can't run away. We can't run away from that information. Mainstream media can't either. But here's how they're changing the housing narrative, right? So now they're saying, well, how foreclosure wave could impact the housing shortage. So what people are saying now is that the pro-housing hacks are going, no, it's not going to impact, because you see what all these people are going to do that are facing foreclosure, they're just simply going to sell their home because they have equity. All right, that's the big thing. You've got so much equity here, you're going to sell your home, or they're going to refi because they have equity. Okay, so great. Let's figure all that stuff out as time goes on. That's not really going to happen. And the reason why I say that, it's because number one, refis, your typical refi, number one, you got to have credit scores, okay, number one. Two, you got to have income, number two. And three, the loan to value on a typical refi maximum is 80%. So if people have, you'll read some of these articles, they'll say, well, the average, the average, loan to value 70%. Well, guess what? If you're going to refi, what you typically do, the max you can take out is 80%. And then, okay, great. So what are you refining? Are you pulling cash out? Are you refining to get yourself out of problems? Because you see, when all these, we'll say analysts look at loan to values and what's owed and what's owed and what equity is, they look at statistics that say, well, this person has, a $200,000 mortgage, and the house is worth $300,000. So they're in a great loan to value situation. But if you haven't paid your mortgage for a year or longer, realize that you don't owe 200, you owe more, because you have missed payments, you have interest, you have fees, you have collections, you have attorney costs, all the things that the lender builds in. So your $200,000 could be $240 or something like that when it's time for a payoff. So if you sell your house or refi, it's a payoff, right? So suddenly that equity that people are talking about is not really there, okay? The equity is based on some very generic calculations. When we start taking a look at individual properties, people who are not paying their mortgage. So again, okay, you can move my forbearance payment to the end of the loan. Great. Well, if I refi my forbearance, that's what they're doing. They're taking all the missed payments and they're tacking that to my loan, which is my payoff. So really, do I have all this equity? I actually don't. Every month I don't pay, I'm legitimately tapping into my equity. So that's why, things are not quite how they seem here, right? So this is kind of cool. But again, it basically this is something that was reported by Redfin, and it boils down to that, what they're saying is the majority of homeowners will be able to work out a plan to exit forbearance and keep their houses. Okay, great. The majority will do that. Well, you know what? Again, as I mentioned, exiting forbearance and keeping their homes means you have income and you have consistent income and you can qualify to maintain. So you got to maintain your existing mortgage payment, and they'll figure out what to do with what you owe. But it's almost like you're almost requalifying again. And when you look at the forbearance numbers, when 80% are re-upping, they're not exiting, they're re-upping for longer terms. To me, that means they don't have the income to exit forbearance. So if things are bad now, are things going to get that much better in the next 5 months? Probably not. So see, this is where we're changing the narrative, or the powers that be, mainstream, whoever you want to talk about, pro-housing hacks, as I said, are changing it, saying, hey, don't worry, all these forbearance and default issues, we're going to have solutions. Sell your house, you got equity. Oh, exit forbearance and refi, everything is good, low interest rates. Well, that's just not going to happen, okay? Oh, investors and first-time home buyers will quickly buy up impending wave of foreclosures from homeowners saddled with debt during the pandemic. Okay, well, you know what? I can tell you that they're saying more than 3.3 million U.S. homeowners will be on the hook for delinquent payments when mortgage forbearance ends, all right? So that's really kind of cool, but this is not all magically going to go away, because number one, this is what happens when someone's not paying their mortgage. Okay, they don't have a place to go. They're not paying their mortgage because they don't have income, which means they can't go anywhere, which means they try to stay in their property for as long as possible, which means they're chipping away at any of their equity, if there is any. All right, and they don't have money to move, and every time they sell, they're not going to put it on the marketplace because they don't want to pay commissions to real estate agents, and also commissions and closing costs are roughly over 6 to 8, 9% off the sale price. So you see, when you start looking at how this stuff actually is going to work out, it may not work out the way this is planned here. So this is kind of what I wanted to sort of review, is the fact that the narrative is changing to a point where, when I say it's the good point, is that the acknowledgement is that, yeah, we got stuff happening. There are foreclosures, there are forbearance. It's not going to magically go away. But this new narrative is sort of saying, well, because we are at the highest equity position, because of low interest rates, because of all these things, we believe that most of these people, the majority of these people, can just sell and walk away, and everything is going to be good, and we're not going to have a foreclosure foreclosure wave coming our way. Well, again, as I said, I beg to differ, because I kind of know how people in these situations have to operate. Okay, it is what it is. Homeowners and forbearance have options to avoid foreclosure. They do. Okay, they can sell their homes. As in my experience, selling foreclosed properties, some people don't take advantage of forbearance because they aren't educated with what it entails. So people aren't in forbearance for whatever reason. Not our issue. They've chosen not to for whatever reason. Okay, can they sell? Sure, they can. But again, it's that closing thing. How much am I going to make? What am I going to lose with my equity that I've eaten away? What am I going to put in my pocket? How can I save money? Do I need to use real estate agents? Like, there's all these things that are going to happen. So, could it be done in some cases? Sure, but chances are it's not going to happen, because they have nowhere to go and they don't want to pay to go anywhere. So they're going to sit there and bleed the equity in their house. All right. Fannie and Freddie will allow borrowers in forbearance to defer payments till the time the home is sold or refinanced. Okay. But again, deferring payments still means that the equity portion is not there. You've eaten away at it. Okay, so that's kind of the way it is. So short sales, yes. They're saying here, if a borrower is in severe debt, they may be able to take advantage of a short sale, which they should do, or take advantage of cash for keys, where homeowners get a one-time payment to vacate the home. Just so we're clear here, and you've probably heard the term cash for keys before. Cash for keys is like the generic name for what's called a deed in lieu of foreclosure. All right, so what that means is that you as the homeowner are voluntarily signing over your property to the lender. There's actually a document called deed in lieu of foreclosure. You sign it, they take the home away from you, and what cash for keys is, they may say, if you sign it over to us, we're going to give you a payment to leave the property, what they call broom swept clean. All right, you're not going to damage it, you're not going to mess around with it, you're going to clean up your stuff, and you're going to go. And you've voluntarily given the home back to them, and they don't have to go through the final foreclosure process, and you're getting cash. Now, how much cash are you getting? You're not getting 20 grand or 50 grand. They don't pay you equity. They pay you $2,500, $4,000. That's what they may give you on a negotiated basis for you to walk away. So it's not like you're coming out ahead here. You get maybe what boils down to a relocation expense is what cash for keys is. So that's why, again, a little bit of play here. Oh, take advantage of cash for keys. Well, I can do better for you on short sales, and I can settle your debt, and we can make it more lucrative for you, and we can make it less difficult for you in a financial perspective going forward. But again, it's how the narrative plays out. So again, we agree that stuff's going to happen, but you know what, though? It's not going to make an impact in our market. Home buyers and investors will snatch up foreclosed homes because of the shortage of homes for sale. So you're going to get multiple offers. When a distressed home hits the market, it gets multiple offers. Well, again, the whole point is, though, that a distressed home hardly hits the market. And as I said, people are going to wait too long before they make a decision to sell. And then if they get caught, it's going to go to foreclosure. Then it goes to the auction where it's competitive. It's taken back by the lender as a real estate owned REO. It'll go through their own, third party auction site, maybe in the MLS. And yes, it will be competitive. So, and this is here. So Fannie Mae has what's called a first look program, which renovates distressed homes and offers them to first-time buyers who will occupy the home. So guess what? These aren't cheaper priced homes. If Fannie Mae takes it back and fixes them and puts them back out as property for first-time home buyers, they're not going to do it for free, and they're not going to give you a huge discount here. It's great for first-time home buyers who don't want to compete with investors, But are you paying a better price for these homes? Of course not. You're going to pay market price for the home. So again, another just sort of red herring to fish us out and make us feel that everyone's working for us here. This chart, Redfin has a chart here. I'm not too sure how they got the information. I see some sources at the bottom, but what they're saying here is the percentage of homeowners deferring mortgage payments by metro. So you've got the metro average loan to value, average home value appreciation annualized, listing growth, median sale price growth, unemployment rate, percent homeowners vary or somewhat likely to foreclose in the next 2 months, homeowners with household income loss, which seems to be significant, and percent homeowners not current on mortgage payments. So when you start going down the list here, it kind of, it ebbs and flows with locations, but you can see that a lot of this group, their loan to value is greater than 70%. You can see that, percent of homeowners not current their mortgage, it varies 6, 9, 10, 3, 6.6, 13, 12. It just depends as you go down the list here. So, yes, it's interesting, but, where are you going to see the more equity? You're going to see the equity in, places like, let me go back up here. I go too fast. You're going to see equity in places like, California, Seattle, those locations where there's a lot of equity. You're not going to see equity in a lot of other locations, right? So Sacramento, 71%, Riverside, California, 71%, San Diego, 71% equity. You got Jacksonville, 69%. Okay. Looks like Los Angeles, 68%, Vegas, 67%. So okay, there's some equity there, but again, closing cost commissions and sales dip into that equity, missed payments, and bringing stuff, carrying forward your loss off your forbearance cuts into your equity as well too. So there may not be much there. And if there's a slight shift in property values, then that chips away at your equity as well too. So it's not like we're seeing 50% equity here, folks. We're seeing on average 70% or more. Yeah, look at Phoenix, a little lower, San Jose, Anaheim, Fort Lauderdale for whatever reason, Miami. A lot of those are cash buyers as well too. West Palm, of course. So you can see those are locations that might work, and other locations not so much. So the point is that it's changing. Where they got the data, I don't know. But again, my point is pretty clear, is that the narrative is changing. It's basically we're going to have problems, but the problems aren't really there, so don't worry about them because there's solutions and it's not going to be a problem. So again, continue to buy your property. So in the end, what they're saying to you is that we don't expect housing prices to drop, so go and buy that property right now because it's probably going to go up next year and you're not going to have to worry about things. You're going to increase in equity. So again, what the powers that be, Wall Street, the government, the hedge funds, the real estate investment trust, whatever, the people that buy at the auction are buying at discounts at the auction, and if they buy at the auction, the properties aren't going back into the open market as distressed inventory, so adding to the inventory, number one, and number two, as cheaper priced homes. So they're buying at the auction, they're taking them off the street, they're making them rentals or putting them back out as retail property, and so therefore buy cheap and not affect our asset-based price point and the marketplace. So again, see how it's being controlled. So that's kind of the point I'm making here, everybody, is that we have to watch this. So how do you do this? Well, you got to get in front of them. That's kind of the point here, is that you got to get in front of them. But I'll give you an example. This is part of the whole where people are thinking, and this is from an investor guy who's selling investment opportunities, right? I'm on all these email lists, but look at this. Tsunami of foreclosures on the way. The foreclosure disaster on the horizon. Foreclosure wave of 2021. Zero down foreclosure deals. Forbearance deals, the new opportunity for real estate investors. Housing market hell. Second foreclosure crisis in a decade. So, again, so realize that, there's people who understand what's going on behind the scenes, and then there's mainstream media, which basically is trying to tell us going, okay, like everything. Well, now it's a soft admit that we're going to have stuff happening, but we're going to go on the stuff will be happening. So we apologize, and yeah, it's going to be tough for some people, but you know what? For the average person, for the marketplace, we're not going to see an effect. Now, I look at that, the article with the U.S. housing market. The housing market will withstand a wave of foreclosures when forbearance ends, with more than 3.3 million of U.S. homeowners will be on the hook for delinquent payments. Well, do you think that 1 million properties coming onto the marketplace will be good? Do you think that can make a difference in price points? Do you think that can make a difference with inventory and opportunities? Certainly can. With 500,000, okay, remember, we're running between 5.5 to 6 million transactions a year. So if we're putting 10 to 20% of these homes, if they're on market, they'd make a big difference. So that's the key. They're not going to be on market. The power, as I said, everybody's going to, the people who are involved are going to prevent them from coming on market. And the whole point is, how do you get them? You got to go after the homeowners and really get them on, on your own market. Okay, that's how it's going to kind of work. So get it before the auction. That's where the deals are. So the cheaper price homes are. That's where the people need the help. If it goes to auction, they've lost. Okay, so you're helping homeowners if you can deal with them before the auction, because if it goes to the auction, they've been foreclosed on. They have a judgment. People will try to collect that judgment. They're going to have future financial issues going forward. It's not a rosy picture. So we got to get it if it go, before it goes to the auction. As I mentioned, 2 housing narratives in play here. K-shaped housing market. So we're running through that right now. Bottom part of the K starting to grow. As I said, my market, I see it changing. Other markets too. It's underway. It's just going to get here a little bit later than we hoped. Properties available right now, it's out there. I'm talking about it now. You can see the foreclosures happening. You can see it all stacking up here. Why are you waiting to get involved? Reach out to me, please. We'll have to compete with institutional buyers and other larger investors for these properties. We have to get ahead of them. That's my kind of point, though, is everything is about getting to the homeowner and structuring deals and buying in that capacity, as opposed to buying from large investors, buying at the auction, buying from REO auctions, having the properties come back once they're foreclosed on in the open market where there's competition, okay, for crummy properties. So there's ways to get around it. That's what I'm saying to you guys. But the narrative's changing, guys. So again, I've talked about this a couple times. Just connect with me. That's my email. Want to talk real estate, want information on what you should do, how you should go about things, how I can help you, etc. Give me a shout. All right. Simple as that. My email. So once again, thanks for the likes, views, comments. I'm still working on that next foreclosure tour, because it's a lot of information to mine through. So hopefully get that done next couple of days, and we'll hopefully the next video. But again, I thought this was important because narrative's changing. It's changed, and now they're putting a spin on this narrative now. Okay, simple as that. Take care, guys. Talk to you soon.